All right, today we're going to pull back the curtain on the world of high finance. We're breaking down exactly how a private company takes that huge jump to become a big name on the stock exchange. We're talking about merchant banking and the whole journey of going public.
I mean, seriously, think about it. That tech company that made your phone or that coffee shop you can't live without, they weren't always public. At some point, they had to go on this incredibly complicated journey to raise money so they could grow. And that journey, well, it has a guide.
So here's the thing. Every successful company hits this wall. You've got a great product, you've got happy customers, but to build new factories, hire hundreds of new people, or expand into other countries, you need a massive amount of cash. And that's the moment they decide to tap into the public markets. And this is our main character, the merchant banker. Forget the old school name. Just think of them as the master architect of a public offering. They are the expert guides, the ones who steer a company through the whole messy, complicated process of selling shares to you and me for the very first time. Okay, so we've got our company, and we've got our expert guide, but where exactly are they headed? Well, they're stepping into the arena of the capital markets. To really get this, you gotta know there are two sides to this arena. First, you have the primary market. This is where all the action starts. It's like the showroom for a brand new car. The company sells its fresh new shares directly to investors to raise cash. Then you've got the secondary market. You know, the NYSE, the NASDAQ, the NSE. That's more like the used car lot, where investors just trade those same shares back and forth with each other. The company itself isn't really in the middle of those daily trades.
And what are they actually selling in this market? Well, the main things are equity shares, which are tiny little pieces of ownership in the company, and corporate bonds, which are basically just loans that investors are giving to the company. The merchant banker is the one who helps the company figure out the right mix to offer.
Right, this brings us to the heart of the story, the IPO, or initial public offer. And trust me, there's a very specific playbook for this. The merchant banker, they're the quarterback calling all the plays. This whole process is a marathon, not a sprint. First, the merchant banker puts the team together. Then, they lead this intense investigation called due diligence. That's to make sure the company's official story, the offer document, is totally solid. After that, it's all about marketing and figuring out the price, which all leads up to the grand finale, handing out the shares and officially listing on the stock exchange. So this due diligence thing, it is the ultimate fact-checking mission. I mean, the merchant banker and their team of lawyers and accountants go through everything. Every contract, every financial statement, every single claim the company makes. It's a massive deal, and it's all about protecting investors and making sure the company's story is 100% true. But how do they even decide what a share is worth? It's not like they just pull a number out of a hat. They use a process called book building, which is basically a price discovery auction. The merchant banker goes to all the big institutional investors and asks, hey, how much would you be willing to pay for this stock? And they use those answers to find the sweet spot that shows the real market demand. And this is the big fear, right, for any company going public. What if you throw this huge party and nobody shows up? What if you don't raise the minimum amount of money you actually need? This is where the merchant banker plays their most critical role. It's called underwriting, and it's basically a financial safety net. The merchant banker guarantees the company that if any shares are left unsold, they will buy them. It ensures the IPO is a success and the company gets the money it needs. It's a huge vote of confidence and really the ultimate risk management move. Now, this entire process isn't the Wild West. Not at all. It's a highly regulated game with a super strict rule book to make sure it's a fair game for everyone involved. You can think of these guys as the referees. In India, SEBI is the main watchdog for the stock market, but the RBI and the Ministry of Corporate Affairs also have huge roles in setting the rules for how companies and markets have to behave. The merchant banker's job is to make sure their client follows every single rule. And look, it's not just about following the law to the letter. There's an official code of conduct that demands that merchant bankers act with the highest integrity. Their whole reputation is built on trust. And this code just reinforces their duty to both the company they're working for and, of course, the investing public. And to back all that trust up, regulators make sure the merchant bankers themselves are financially solid. It's called the capital adequacy requirement. It basically ensures they have enough of their own money in the bank to handle market shocks and, most importantly, to actually be able to buy those shares if their underwriting promise gets called in. And that requirement isn't just some vague idea. In India, a top-tier merchant banker has to have a minimum net worth of 5 crore rupees. That's the baseline, just to even be in the game. But the story doesn't just end when the opening bell rings on IPO day. Nope.
The merchant banker's job often keeps going long after, guiding the company through its brand new life as a public entity.
See, merchant bankers are the go-to experts for all sorts of major corporate events. They give advice on complex mergers and acquisitions, they help companies buy back their own shares, they manage the sale of government assets, and they arrange private fundraising deals behind the scenes.
And just to clear something up that confuses a lot of people, a merger is like two companies getting married to create a totally new family. Think company A plus company B equals a new company C. An acquisition, on the other hand, is when one company, usually the bigger fish, just buys and swallows another one. So if we boil this all down, here's the key takeaway. The merchant banker is the absolutely essential link in our modern economy. They're the architect who designs the deal, the guide who navigates the crazy process, and the gatekeeper who manages risk to make sure only credible, solid companies get access to public money.
They are the invisible hand behind some of the biggest business stories you see every single day. So the next time you hear that some hot new company is going public, you'll know the playbook, you'll know the players, and you'll know all about the expert guide making it happen. So the only question is, what company's journey are you going to watch next?